Welcome to Growing E-Commerce. I'm your host, Mike Ryan of Smarter E-Commerce. Today, I want to share a trend update for the year so far. First, we'll discuss what Simeon Siegel calls DTC. That's the way direct-to-consumer businesses have shifted under pressure away from solo digital pure plays to adopt offline storefronts and wholesale partners. It's kind of a reversal or an undoing of the DTC model so far. Then you'll hear my thoughts on the interplay of marketplace business models and retail media networks and the ways in which Europe differs here from the US market. And lastly, let's have a look at Q1 earnings reports from Alphabet, Meta, and Amazon. Final thought, the one thing all these players have in common is traffic acquisition. All right, let's get into it. So today I just want to catch up on some of the things I've been reading, some of the conversations I've been seeing, and my thoughts on those topics. And I'm going to touch on a few themes about, what we've seen in 2022 so far. I definitely want to talk about direct to consumer, how that kind of business model and the hype around that is evolving or devolving. We'll talk about DTC and the DTC movement. Then moving on to what's happening on the retail side, and catching up on a similar hyped trend over there with retail media networks and marketplace models, what's happening there. And lastly, I'll just talk through some recent earning reports that came out at the time of recording last week. And I'm putting that at the end in case you're listening to this, dear listener, in the distant future. Maybe this stuff is of historical significance to you, or maybe it's that information is less relevant. But on the other hand, maybe it's kind of interesting as a historical artifact because there's so much uncertainty ahead right now with the inflation that we're facing, with the war in Ukraine, with the pandemic evolving and seeming to tail off, but no one's quite sure. It's a really interesting time to look at all these themes. So let's start off with this idea of DTC. And right away, I'm going to credit that phrase to Simeon Siegel. I actually just discovered his reporting and coverage recently in the last week or two, and really interesting guy, definitely one of the sharpest observers out there in what's occurring with direct-to-consumer and a lot of topics. And you never know. It's tricky because a lot of the things that I hear him saying, I've thought myself, and I don't know if some of them are my ideas or I've read them on Twitter, or it's just funny the way that opinions kind of form, and to what extent maybe Simeon and his team are opinion leaders, or to what extent they're capturing this kind of zeitgeist that's out there, that the things that a lot of us are seeing and observing. But as mentioned, really worth checking out his articles and interviews. But when I think about direct-to-consumer, I think some important context to add. I mean, there have been people talking about sort of the death of direct-to-consumer, or that this business model or approach is overhyped for years now, for a longer time. And I guess where it kind of came to a head in more recent history, let's rewind to third quarter 2020, because I think this is where some challenges started to arise. At the moment back then, it just looked like e-commerce was booming. Everything was just on fire, and we saw this reflected in investments. Venture capital in e-commerce was up $1 billion US dollars in Q3 2020. That's 63% increase year over year. That's a lot of venture capital flowing into the space, and new business formation, entrepreneurship. Let me try that again. And new business formation, entrepreneurship was up over 80% in Q3 2020. So look at those two things going hand in hand: the venture capital flowing in, the businesses forming. And I'm not saying that every one of those was a direct-to-consumer brand, but certainly some of them were. And it just shows that there was already a big hype around direct-to-consumer, and then it blew up into a bit of a bubble. And, then you can queue up what happened next. The privacy changes made by Apple, the collapse in demand that we've seen over time with the pandemic, where things kind of shifted back offline. And broadly speaking, these direct-to-consumers, kind of insurgent brands, they've positioned themselves as digitally native. They've invested heavily in digital acquisition channels and less so in physical storefronts. That's been kind of their philosophy, and that worked out pretty fine when traffic was cheap to acquire and Facebook was zipping right along, helping products get discovered, helping brands get discovered. And this stuff was readily attributed. I'm not saying that Facebook is no longer helping stuff get found, products and brands get discovered, but it's harder for people to have confidence in the math around that and the attribution. The picture is just a lot fuzzier. And yeah, also the unit costs. It's about the unit costs as well, which have been very volatile and often quite expensive. So it's not such a surprise to see the pendulum swinging the other way a bit. And I guess what bugs me is I see analysts and headlines that are quite harsh toward that business model and toward these business owners. I think if anyone might deserve a little bit of blame, it would be perhaps the venture capitalists, but everything's so clear in hindsight. That's the classic, and it's the case here as well. And I just think these business owners, by and large, I don't think they were trying to mislead anybody. They were trying to build something. They are trying to build something and sustain something. But nowadays, the recognition is definitely shifting it into the idea that, hey, direct-to-consumer is maybe not a business model in and of itself. It's just one distribution channel. It's just one way of operating, and these businesses need to diversify a bit. You run into a problem with these acquisition channels like Facebook in particular, where it can only scale you up to a certain point, right? And the same thing with that single channel, direct-to-consumer channel at large, it can only scale you up to a certain point. Now we see that wholesale is becoming a lot more popular and attractive as a way to scale, and we see that also physical storefronts, brick and mortar, becoming more attractive as well. And I'm a bit more, I would say, optimistic about the wholesale side of things than the physical storefronts. But there are two sides to this. Like, kind of the core driving thesis of the direct-to-consumer model, of course, is that you're cutting out the middleman and that there's more profits in this way of operating. That's why these businesses chose to operate the way they did. It's why venture capitalists got excited. These are all smart people in the room. And again, that's why I think it's easy to be critical of some of these businesses, and maybe some of them do deserve that criticism, but many of them is really honest shot, and they're adapting now. So I think that's positive. The reason I find wholesale attractive is that, it's pretty tried and true. And these are companies that they've got the infrastructure and the logistics in place where they can do this in a scalable manner at the profitability that they need. And what we found with direct-to-consumer is that these businesses didn't have that stuff in place, and they underestimated how much it would cost to set that up and how much it would eat into their profits to do so. And wholesalers, it's a tried and true distribution channel. It's nothing new. And there's a value. Of course, you sacrifice, hold on, let me retry that. And of course, there's a value there. So you might say, oh, there's a middleman eating into my profits. Well, that's in exchange for clear value adds as well. So you just have to run the math and see if that makes sense. And when it comes to physical storefronts, I'm a bit more skeptical because, again, I think that there are already folks out there who really excel at physical retailing, and it makes more sense to me to probably get involved with those operations rather than trying to set up your own operations if you're brand new to this. But can't say that isn't going to work. And actually, I just talked on the last episode with Sean McGinnis at Kuru Footwear. They're looking into this too. And you can hear his thoughts about what they're thinking of doing and why. He sees an inherent value also in a physical storefront as being this kind of artifact in the world, this marketing value of helping to kind of concretize this brand and make it more tangible to folks. But it's just the way that the story has been so far. Some of these larger brands went public. Suddenly, their numbers went public too, of course. The way their books looked wasn't quite the way that people imagined, and it turned into an emperor has no clothes kind of situation. But again, I don't think that direct-to-consumer movement is over. Some of these businesses probably will fail, unfortunately, and others are going to succeed wildly. So it's just as we face this tricky environment ahead with inflation, increasingly talk about a recession ahead, a possible recession. We just have to be aware of that. But again, check out what Simeon Siegel has written about this. I love that phrase of his, DTC. So not like, it's like anti-direct-to-consumer, the things that are happening out there. And on the one hand, it's the sentiment side, I think. And on the other hand, it's also that these businesses are adopting new practices that were maybe considered counter to the way that they imagined they would operate in the past. The idea of wholesale partnerships or retail partnerships being taboo. The idea that, hey, we can pull this thing off purely in the digital space and we don't need to be in the physical world. I mean, I also discussed this with Brian McBride. You can listen to that a few episodes back. He's the former CEO of Amazon UK and chairman of ASOS. And he felt that these brands are probably not going to move into the physical retail world. And back then, I definitely was thinking, this is a trend that could pick up. And my core reasoning for that is that even if, let's say that we reach like 20% retail penetration for online sales for e-commerce, let's imagine that online is capturing 20%. That still means that 80% of these sales are still happening offline. And that's a big piece of the pie. So again, it comes into question, can these companies scale the way that they want to scale? Can they reach the kind of valuations or returns that investors might have, or the expectations that investors might have? And kind of try to redo that sentence. So the question is, so with 80% of the volume still lying offline, it's again this question of these boundaries to scale. Do they need to be offline in order to scale up? And what's their approach to getting offline? Are they going to do that themselves with their own storefront? Will they do it through partners? Yeah. You can cut off the please. So if we want to connect over to what's happening on the retailer side with these marketplace models and these retail media networks, I want to come back to that topic about Apple and the privacy changes that they enforced and the way that this has challenged digital attribution. And generally, when we look forward with cookies getting deprecated and the challenges that we expect ahead increasingly on a global scale, not just in Europe, but in North America as well. And we'll see which other markets will follow with these strict privacy laws. The question is, how do I attribute my online sales? And there'll always be a bias toward closely attributed sales. There's another kind of more philosophical question. Why is it so important to me that this stuff is attributed? And different people in different parts of the organization will probably have a different approach to that or a different reasoning. But certainly to the chief financial officer, they're going to have quite a reasonable bias toward attributed revenue. And to close the loop here, bring it over to marketplaces and retail media networks, this is, an end effect, pretty privacy safe and closed loop attribution, because at least when you're talking about these on-site ads in the retail media networks. And so that makes it very attractive. And I think if we do get into an environment where we're looking at more of a recession, and this slowdown in demand, like on the one hand, we're just kind of returning to pre-pandemic levels. And on the other hand, like if we're talking about e-commerce share of revenue, for example, on the other hand, if we're talking about inflation and geopolitical uncertainty, things look a bit more challenging. But in a context like that, in that environment, then of course, having a close, tight attribution can make your channel more attractive, and it can by default make these retail media networks pretty attractive to participate in. If people feel that the targeting is better, the performance better, and they can get easy, clear measurements, then this is going to be a driving factor of that for sure. Boston Consulting Group has assessed the whole retail media network space at $100 billion US annual revenue. So that's quite a market opportunity right there. And the other thing that we know about retail media networks so far is that they're characterized by these high margins, at or above 50% margin on there. So this is something, again, that makes them pretty attractive for everyone involved. And already in the US, we're seeing that ad spend on retail media networks is about 17% and forecast for 19% of ad spend next year. So that's pretty significant. Amazon is, of course, dominating the whole market, Amazon's retail media network, and that's sized at about $26 billion US dollars. You see different estimates out there. And then there's kind of this long tail of other networks, like these large US retailers, Walmart, Target, Kroger. My assessment is that the EU is a bit lagging here, and that means that it's a growth opportunity. We see marketplaces increasingly coming into place in Europe, and this is a great kind of first step to then leverage into a retail media network. I mean, the marketplace model has an inherent value, arguably, in the form of, for example, getting some range expansion, or focusing on product depth through onboarding sellers, just that you can serve the needs of more customers on your owned property if you're that retailer. And then if you can then monetize that by retail media, it becomes a pretty interesting case. There's always a push and pull with marketplaces, and ad networks too. Both of these depend on these network effects where you need to kind of concentrate a sufficient pool of both supply and demand. And it gets called different things like a critical mass challenge, or a flywheel kind of problem, or a flywheel opportunity to look at from the other side. It's very hard to get a flywheel started to get that initial momentum. But once you do, it's kind of self-sustaining. And by the way, I discussed this a little bit in an episode with Mihai Popescu. If you want to check that out, a couple episodes. He's over at Esprit right now. But he's worked at marketplaces in the past. And the topic here in Europe is, I think it gets even a little bit harder. So there's this critical mass challenge, right? Where you basically need to have enough sellers on there that it's attractive for consumers to visit this place as a destination. And you also, on the other hand, you need enough consumers attracted to this space that it's attractive for sellers to get on board. That's if you're looking for classic kind of scaling effects. But with a retail media network in place, you might not need the scale per se. There might be an opportunity to monetize further through the retail media. But the other challenge in EU is that we're generally more fragmented than the US market. Still, we see some big players out there like Zalando, Bol.com. I think one thing that was interesting for me is that Bol.com partnered with a North American player, PackView, when they launched their marketplace. And this is not surprising, or excuse me, when they, when they launched their marketplace, let's say. And this is not surprising because, of course, the North American market just seems to be a lag ahead of the EU market here. So I think that's a pattern that we could see repeating, that these North American firms are well situated to kind of crack the EU market due to their prior experience. And generally the EU market, so it's less dominated by Amazon. There are more local players out there, like a Bol.com, for example, sort of the Amazon of Netherlands, you could say. Similarly, like in Poland, you'll see Allegro, kind of the Amazon of Poland, and there are different platforms out there like this. But yeah, although Amazon is not that dominant market force, and there could be more opportunity that way, on the other hand, it's just so fragmented. So I think there'll be these strong geographic players, there'll be strong vertical players like Zalando and fashion, and it's just going to be a matter of seeing which of these companies can get to the right size, that they're big enough that this whole model makes sense for them, and also that they're let's leave it at that. A last comment on my side related to retail media networks. I think it's quite interesting to see that Google Cloud launched a new retail search function lately. And to me, I just have to ask the question about why Google develops a technology like that. They have quite a clear kind of value proposition there that a lot of on-site search experiences for retailers, it's not good. And this is damaging their conversion rates. It's damaging the customer experience. Customers might not return to those websites after having a bad experience. And so it's clear that Google has a competence in search, and they can deliver Google quality search. That's what they claim to do here. And that then this runs to their cloud infrastructure. So there's a financial model for them there. On the other hand, I also have to ask myself, isn't it kind of good for Google if people have bad searches on retail sites? Because then those retail sites are less likely to capture share of product search, because those commercial search queries, that high intent commercial search, is so important for Google. And they already see product searches getting siphoned away by Amazon. And then they would be kind of, arguably facilitating that more product search gets siphoned away by individual retailers. And so I don't know what their strategy is here or how they run the figures on this. Maybe they don't see it as such a threat. But I think another thing could be that retail search and maybe some additional features coming from Google Cloud could be viewed as infrastructure for retail media networks. And that's a different case. If it's just the search engine, like just a retailer's on-site search running over Google Cloud infrastructure, I don't think the case is that compelling. But then if Google is able to use their infrastructure with Google Marketing Platform, for example, to facilitate that there's paid search occurring and retail media placements occurring on these sites, and they view high quality search as a prerequisite for that, I think the calculus kind of starts to look different. And this is one possible explanation, because there's a lot of people playing for that 100 billion market that BCG mentions, like Criteo, for example, trying to sort of reinvent themselves a bit. And I think this could be a big strategic initiative for Google now and in the next couple of years, that they can get these retail media networks running on their infrastructure, on Google Marketing Platform, on Google Cloud. And this could help offset, let's say that they start seeing revenue losses the way that Facebook did. Facebook saw like this crippling, what was it? I can't remember. Don't quote me, but I think it was like a 10 billion revenue loss last year from Apple's privacy changes. If we view retail media networks as more privacy safe and just generally a strong growing trend, and Google can get a piece of that pie, then it can really offset potential revenue losses that they might face through privacy initiatives or whatever else is coming ahead. Increased scrutiny on them right now from the US, looking to break up their advertising kind of monopoly. And also in the EU, there's new scrutiny about the way that they send kind of low quality spammy ads to their search partners. Yeah, so it's an interesting space to watch. And that just reminded, I'll leave that out. So while we're on the topic of Google or their parent company Alphabet, let's transition over to the recent earning reports for Q1 2022. When we talk about Alphabet or Google, YouTube was a particular challenge there. At least that's what the pundits are saying. They faced slowdowns on video consumption from the pandemic. People are kind of returning to other sorts of activities now that lockdowns are by and large over. And also, what I think might even be more significant is increasing competition from TikTok, taking away a lot of that social video traffic. So in the end, their YouTube ad revenue was off by like $640 million US dollars. And I don't know, I don't view it maybe that critical. I think that considering everything that's going on with the pandemic, the way that played out, and I think the picture still looks pretty solid for Google there. Their traffic acquisition costs continue to rise, so that's a bit concerning. But if we also look at their click growth, we can have a discussion about that. Like in Q1 2020, so that was arguably pre-pandemic. I mean, it was at the very kind of the very edge of the pandemic. Their clicks were up 12% year over year, and that is, bear in mind, that's their clicks across all their advertising inventory. So not just Google search or display or anything, but or YouTube, that's everything. And then they had this massive growth quarter in Q1 2021 that was kind of a pleasant surprise for a lot of people with plus 25% up a quarter. I remember in late 2020 thinking that there could be already kind of a whiplash or the pendulum swinging the other way on e-commerce and on digital advertising back then, but the pandemic just lasted a lot longer than we expected, and so they still saw really superb growth. And now this quarter, they were up 16% on click growth. So which you can, this is the root cause of their ad growth are these clicks. So it's still better than their 2020 number, and I think it's pretty solid. What the next thing to look at is what about the cost per clicks, and that's another topic. I mean, we're seeing that cost per clicks are up 8% in Q1 this year, and this is a factor because it just tests how much advertisers are willing to spend for these clicks. 8% might not sound like the most, but for some context here, like across 2020, I looked at their past earnings statements for like 2019 through present and through their cost per click growth into a sheet quick. It's pretty interesting to see. I mean, across 2020, CPCs were down. And, you could expect about a 15% discount in 2020 on cost per click relative to 2019. And then last year in 2021, they really overcompensated that change and they started growing. So not just in relative terms, but in absolute terms, the CPCs were getting a lot more expensive. Particularly the quarter to watch there was the second quarter last year where they spiked 31% year over year. So it got a lot more expensive at that point to advertise on Google. or with Google. And I think the next quarter to look at will be Q2 this year, because there was that tremendous growth last year, and let's see what it's going to look like this year. Right now we're seeing 8% on top of the kind of overcompensated or more expensive CPCs from last year. And it's just a question about at what point might this start to hurt them if it's getting expensive. So Amazon, they faced a challenging quarter, and to me, it's a little funny. The things that they faced, things that have been discussed, they faced excess capacity that they built up for the pandemic. And so, the counter side of that is that consumer demand tailed off a little bit. That's what makes the capacity excess. Of course, they go hand in hand. And then the third factor that was discussed is inflationary effects. And so then by most assessments, they missed their ad growth projection too, by the way, if we're talking about advertising. But the part I find funny, or it's such an Amazon problem, is this idea of excess capacity, because I can't think of a lot of retailers out there where I would really say their excess capacity is a problem. Right now, supply chain is the problem everyone's talking about. Getting good people, hiring people is a problem that everyone's talking about, retaining people. And so then to see Amazon facing excess capacity, it just shows you how big it is, what they've built, and how aggressively they plan for the future, that when most people are facing shortages, Amazon suffered some profitability problems because of excess capacity. So yeah, that's a very, very Amazon thing from my perspective, which kind of brings me to Facebook, but in a very different light. Actually, hold on. I'll make that transition in a moment. And this reminds me, so back in episode 1, the first episode of this podcast, I interviewed my former boss, Steve Scheinkopf. He's the CEO at Yale Appliance in Boston, Massachusetts. And I saw a great article from Steve last week where he was talking about challenges that he's facing in the supply chain right now, and also actions that he's taking to kind of protect and ensure his capacity. So what I found, really a couple of things that were really interesting in that article, there's a lot, but he mentioned just how much warehouse real estate has been snapped up by Amazon in the area, in Massachusetts, southern Massachusetts, and also how much, if we get back to the venture capital investments in e-commerce, how much real estate has been snapped up by venture capitalists and banks. Just these warehousing real estate has become so valuable, such a hot commodity. I think last year, a lot of us saw these charts about the shipping containers and how explosive the growth in pricing was there. But just to use a concrete example, what Steve saw, he mentioned that Yale bought 2 warehouses, and this was a few years ago, because I was still working at Yale back then. So this is about 5 or 6 years ago. And we were just opening up one of the new warehouses, and that cost them $5 million. So that was, let's say, 5 years ago. And now in 2022, Yale has made an agreement to buy a new warehouse for $45 million. So that's a 900% increase in just a handful of years. And I think it shows you how insane it is what's occurring in the market. And yeah, getting back to that thing about Amazon having a capacity problem. So that just kind of triggered a thought in my mind. I mean, one thing I've noticed about Amazon in the past years is that their profit per employee has been kind of declining. And that could be thought of in a couple different ways, making a long-term play to have this talent and to have flex capacity. And also it's the kind of work that those employees are doing. But I want to switch over on that note to Meta or Facebook, their report. I mean, their headcount is up 28% year over year. So this to me was one of the most striking things about the report. And I think their headcount had exploded already a bit last year, but it's up 28% year over year. And I'm not 100% sure, but I think a lot of that headcount is busy programming the metaverse. And I don't know how history will judge me on this, but Facebook and Meta, they've got such big problems right now. I mean, and Zuckerberg is talking about metaverse as a project for the 2030s. It's definitely a big bet. It's a very big bet. To me, I'm just curious about their bridging strategy to get that far, because I think they kind of are a little too far-sighted here, and they might be missing the things that are right in front of their nose. They had such a bad Q4 last year. It was historically bad, and the fact that they just had moderate performance this quarter was kind of favorable for them, or viewed favorable, because they just have these fundamental problems. I think they've got problems retaining advertisers. They've got problems retaining users. I mean, not last quarter we saw that they struggled with their active users, and I think they returned to some flat growth again and not negative growth. But I'm so skeptical of this whole metaverse bet, to be really honest. I think, I'm not saying I'm skeptical of the technology at large, but if Facebook is going to be the company to really pull this off, I would be pretty surprised. I think it's going to be somebody a lot more agile with a lot less baggage. But yeah, those are my notes for trends that I'm looking at right now, and things that I'm reading about and learning about. And I just want to maybe wrap it up on one thought. I think the challenge that everybody has in common in the end is just traffic acquisition. If we look at the direct-to-consumer businesses, it's a question about how they're going to acquire customers, and in an online context, how they're going to acquire that traffic, because they have to convince people to go to their brand website for their product. And generally, there's a sentiment that consumers want to do one-stop shopping, and this is why Amazon is such a value proposition. And likewise with the retail media networks and these marketplaces, as these larger retailers look to explore new business models, again, it comes down to convincing people to come to their property. And same with Google here, facing their rising traffic acquisition costs. It's just everybody is in this big, huge competition for eyeballs and attention and wallets right now. And it's the big ones, it's the small ones. This is a tense environment for everybody. So I think now is definitely the right time to keep thinking about acquisition. Retaining customers and users is a topic as well. But the people right now who are winning at acquisition are going to be the people who are winning in the longer term. That's my take on it. But I want to thank you for listening. And I'm lining up some really interesting guests for the next episode. So don't forget to subscribe or follow this podcast. And I hope to check in with you again next time. Thanks so much for listening to Growing E-commerce. And if you enjoyed this podcast, please consider sharing it with coworkers, friends, or within your professional network. We really appreciate it. This podcast is produced by Smarter E-commerce. To learn more, visit smarter-ecommerce.com.